Negative 0.6%. U.S. retail sales just took a shocking dive. And with American consumers suddenly slamming on the brakes, we really have to ask, is the Federal Reserve finally done raising rates?
Hello everyone, welcome back to AI Market News. Today we're diving into an explainer on this rapidly shifting macroeconomic data and exploring what this sudden weakness fundamentally means for all of us and the global markets.
Based on available data, the weakness we saw in July was incredibly broad-based. Overall retail sales plunged, coming in at a negative 0.6% and vastly underperforming the positive 0.1% expectation. We saw auto dealer sales fall by 1.8%, online retail drop 2.2%, and even essential grocery spending ticked lower. This clearly shows that American consumers are decisively pulling back across multiple sectors. And the underlying mechanism here for households is pretty brutal right now. When borrowing costs stayed this high for this long, people just have to tighten their belts. They prioritize basic bills and debt servicing over discretionary shopping.
Adding to the gloom, the preliminary August reading from the University of Michigan shows consumer sentiment just took a pretty big hit, dropping to 51.0. That is well below the consensus expectations of 54.5. And at the exact same time, one-year inflation expectations actually edged up to 4.3%. So what does this tell us? Households are feeling the squeeze right now, and they're firmly bracing for these elevated prices to stick around.
Now, we might wonder, why does this specific pullback in consumer spending matter so much? Well, consumer spending, which is just individuals purchasing goods and services, makes up roughly 2/3 of the entire US GDP. When the consumer taps out, it acts as a giant flashing red light for slowing economic growth. This makes it incredibly difficult for the Fed to justify another rate hike without risking a severe recession.
As a direct consequence of this data, the probability of a September rate hike has practically collapsed. According to current market information, the odds are now priced at roughly 30%. To put that into perspective, that's down from over 55% just 2 weeks ago.
We are literally watching the hawkish case for the Fed erode in real time. Remember those 3 dissenters at the July FOMC meeting? Their foundation is cracking. July's CPI cooled to 3.4% year-over-year, with core inflation hitting 2.5%. The producer price index was totally flat month-over-month. Throw in a decline of 23,000 in July payrolls, and you can see why that argument is rapidly losing ground. With inflation, employment, and consumer spending all softening simultaneously, the hawkish stance is incredibly hard to maintain.
Yet, as you can see in the chart, U.S. equities are holding remarkably steady despite all this soft macroeconomic data. The S&P 500 just posted its 3rd consecutive weekly gain and actually hit an all-time closing high on Thursday. It might seem totally counterintuitive, but right now, bad economic news is acting as good news for stocks. Investors are betting the central bank will have to lower rates, which makes corporate borrowing cheaper and future earnings more valuable.
Looking at Friday's market close, we only saw minor dips across the board. The S&P 500 closed down just 0.17%, the NASDAQ dropped 0.28%, and the Dow Jones slipped 0.20%. Meanwhile, the VIX, the market's fear gauge, remained incredibly calm, settling in complacent territory at 14.25. Despite the underlying shifts in the economy, investors just aren't panicking.
Moving over to the bond market, the graph shows the 10-year Treasury yield has effectively stalled out at 4.688%. While that is still high historically, this combination of weaker economic data and fading rate hike expectations is essentially acting like a ceiling. It's keeping yields from pushing any higher.
Turning our attention to Tokyo, as you can see in the chart, the Nikkei 225 rallied 506 points, or 0.74%, to reclaim and recover above that crucial 69,000 level. That marks an impressive 5th consecutive day of gains for the index.
This rally is heavily driven by Japanese tech and semiconductor leaders. We saw Advantest add 173 points, Tokyo Electron up 77 points, and Kioxia gaining 71 points. Why the sudden surge? It all connects back. Lower U.S. bond yields are generally treated as a major positive for risk assets globally, making the valuations of these high-growth Japanese tech companies look much more attractive to investors.
However, the actual domestic economy in Japan is sending some concerning signals. Q2 GDP came in at just 1.1% annualized, completely missing the 2.0% consensus forecast. Alarmingly, private consumption actually turned negative for the first time in 8 quarters, and business investment declined too. So while that headline GDP number was technically positive, it was mostly propped up by falling imports rather than any genuine domestic strength.
In the currency markets, as you can see in the chart, the USDJPY dollar-yen exchange rate is directly tracking these shifting US rate expectations. The mechanism here comes down to the yield differential. As US rate hike odds drop, the yield gap between US Treasuries and Japanese government bonds shrinks. That takes the wind out of the US dollar's sails relative to the yen.
We also have to factor in some massive geopolitical risks right now. The ongoing US-Iran conflict, ceasefire violations, and disrupted oil shipments through the Strait of Hormuz are keeping Brent crude prices stubbornly high, staying above $87. This is exactly why inflation remains so sticky. Expensive energy drives up the cost of making and moving almost everything, muddying up what could have been a clean, easy disinflation story.
Looking ahead, we have a crucial week of data for all of us to monitor. We'll get July housing starts on Tuesday at 8:30 a.m. ET. But the real marquee event of the week is Wednesday at 2 p.m. ET, the release of the FOMC minutes. We'll be combing through those to gauge exactly how widespread that hawkish sentiment really is among the committee members. Then on Thursday at 8:30 a.m. ET, jobless claims and the Philly Fed Index will give us a real-time pulse check.
Rounding out the week on Friday, at 8:30 a.m. ET, which is 9:30 p.m. JST, Japan releases its national CPI. With core inflation expected around 1.8%, this reading is absolutely critical. It will directly shape expectations for the Bank of Japan's September policy meeting, where a hike is already being priced in. Shortly after, at 9:45 a.m. ET, U.S. flash PMIs will tell us if this consumer slowdown is officially bleeding into the broader economy.
Ultimately, the core narrative this week boils down to one massive question. Has the macroeconomic data deteriorated just enough to force the Fed's hand, or are we teetering on the edge of a deeper consumer recession? Wednesday's FOMC minutes will be our first real test to see if the Fed is truly done. Thanks for watching. Please subscribe and hit the like button.
This video was automatically generated by Gemini Notebook AI. AI-generated content may include errors. This video does not constitute investment advice. For full details, please check the description below.